Thank you for joining me. I'm Alex, and I want to talk about Yum brands today because they should also not be affected by a recession too much. And so I figured it's time to see if they're bargain at the current price. So what they do is fast food. So we're talking about Taco Bell, Burger King, several others, Pizza Hut. That's another good one. So mainly fast food. Mainly reasonably cheap fast food. So Taco Bell, for example, I can probably get a meal cheaper than I can make it myself, which is just weird. So current price $70.67, which gives them a market cap of $21 billion. Current dividend yield is almost 2.75% with a 41% payout ratio, which is pretty decent. Revenue $5.6 billion, slightly down. Earnings $1.3 billion, down significantly, which gives them PE of currently 17 with a forward PE of 15, which is pretty decent. Total assets $5.2 billion, total liabilities $13.2 billion, which gives them total stockholders equity of $8 billion in the negative. So basically they're owing $8 billion, which is not great. And they actually owe more than the previous year, which was also $8 billion. It's just that these $8 billion are rounded down when the current ones are rounded up. So balance sheet is not great. And they've just been downgraded to junk rating in the credit market. So it would be fairly hard for them to raise more money because of their balance sheet, basically. So overall, the balance sheet is not great. The risk factors, though, are also not terrible. I really don't think that there's anyone entering the market right now, and I really don't think that consumer behavior is going to shift significantly for the cheap fast food while the current situation or maybe a recession is going on. So overall, I think that all the risk factors have played out already, and I don't think that there's anything new coming up either in the past or in the future. The problem is the balance sheet and the credit market. Obviously, money is fairly hard to come by right now. But with that said, I don't expect them to have many problems in cash flow that they didn't have before. And as such, since they're profitable right now, I really don't think that they need to get more debt on the balance sheet. And with that, I really don't think they'll be hugely affected by the problems with the credit market. So overall, I would say the dividend is decent, and the growth is not existent, neither in the revenue nor the earnings, which is a problem for me. The balance sheet is absolutely terrible, which is a problem for me. So pretty much all you're left with is a decent dividend with a decent payout ratio, and maybe they handle things better in the future. It's really not a great overall stock, I think. So I'm definitely going to keep my hands off of it. Obviously, for a growth investor, there's nothing here because there's no growth. For a value investor, the PE is decent, the earnings are decent, the dividend is decent, but the balance sheet is absolutely terrible. So for a value investor, I don't think that's the stock for you. For a dividend investor, I think it's a slightly different situation. If you can overlook the terrible balance sheet, and if you think that they'll be around in 5 to 10 years, I think it would still be a decent buy for a small investment, basically to diversify. But other than that, I would still probably keep my hands off of it and maybe buy something else that has a more balanced balance sheet, and really don't like companies that have a negative stockholders equity. So I suggest just not buying it, especially in the current situations when there's a lot more stocks around that are at a lot better price, and you can find some really good bargains right now. So really don't suggest buying that. And that's it for me for today. If you like this video, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.